In 2025, U.S. national debt surpassed $38 trillion, and annual interest payments alone have approached, and at times even exceeded, $1 trillion. This is not a distant forecast, not a number projected for the future, but a reality that exists right now in the federal budget. What is noteworthy is that most people, and even many investors, tend to view this figure in two extreme ways. Either dismissing it as large but not yet a problem, or panicking and seeing it as an unavoidable sign of imminent collapse. Both perspectives miss the most important part of the issue. Markets do not operate on emotion, and currencies do not collapse simply because a number is large. What many people misunderstand is not the level of debt itself, but how that debt interacts with interest rates, capital flows, and the confidence of lenders. When interest rates rise, the same amount of debt creates a completely different level of pressure compared to a prolonged period of cheap money. And when capital flows begin to change their behavior, markets react even before the news appears in headlines. The content you are watching is not intended to predict the collapse of the United States, nor is it meant to spread fear about the US dollar. This is not a financial prophecy, nor is it an apocalyptic story wrapped in statistics. The goal here is to analyze the actual operating mechanisms of the monetary system and capital flows, in order to clarify which signals carry genuine warning value, which are merely short-term noise, and why markets are reacting in the way we are currently observing. More importantly, this analysis is designed to help viewers make better decisions in an environment of uncertainty, rather than to push them toward hasty actions. When you understand how debt, interest rates, and capital flows are interconnected, you will no longer be swept along by sensational headlines or paralyzed by fear. Instead, you will have a clear mental framework to assess risks and opportunities. We are living in a period where news spreads faster than ever before, yet large pools of capital still move quietly and with discipline. Those who react to news are usually the ones who arrive late. Those who understand the mechanisms and can read the signals are the ones with an advantage. To do that, we must first return to the most fundamental question: what is truly changing in the economy and the monetary system today, and why do those changes matter so much? If we set aside sensational headlines and look directly at the data, the first thing that needs to be clarified is that what is changing today is not a single isolated event, but a series of overlapping movements involving debt, interest rates, and capital flows. In recent years, the pace of U.S. debt growth has far exceeded that of earlier periods. However, the absolute level of debt has never been the decisive factor in determining risk. The key issue lies in the fact that the cost of maintaining the debt is rising faster than the budget's ability to adapt. When interest rates remain higher than they were during the 2010 to 2020 period, each new round of debt issuance carries larger interest obligations, making budgetary pressure increasingly evident. At the same time, global capital flows have begun to adjust their allocation. There has been no massive wave of capital fleeing U.S. assets, but rather a subtle and selective shift. Some investors have reduced their exposure to long-term bonds, favoring shorter maturities or assets with more defensive characteristics. This is a rational response in an environment where the cost of capital is no longer cheap and uncertainty surrounding monetary policy persists. Capital has not disappeared. It is simply seeking places that better align with the level of risk investors are willing to accept. Market reactions reflect these changes quite clearly. In the bond market, rising yields correspond to falling bond prices, indicating that lenders are demanding higher risk premiums. This does not affect only the government, but also spills over to businesses and households through mortgage rates, consumer loan rates, and corporate financing costs. The U.S. dollar is not weakening in a single direction, but has become more volatile, reflecting the tension between its role as a reserve currency and the pressures stemming from debt and interest rates. When global uncertainty increases, the dollar is still sought as a safe haven, but when domestic pressures intensify, the currency also undergoes adjustment. Gold and certain other tangible assets have risen in price not because of fear of collapse, but due to the demand for hedging against monetary and policy risks. Investors are turning to assets that are less dependent on central bank decisions. Meanwhile, equity markets have become more sensitive to interest rates, fluctuating sharply with each policy signal. Real estate, which benefited greatly from the era of cheap money, has begun to slow as higher borrowing costs reduce affordability and liquidity. The true significance of these reactions does not lie in market panic, but in the fact that the system is adjusting to adapt to a new environment. The period of ultra-low interest rates and abundant liquidity that lasted for more than a decade has come to an end. In its place is a phase in which the cost of capital has become the central factor in virtually every economic decision. Most of the current fluctuations are corrective in nature, but they also send a signal that existing structures are no longer fully suitable in their original form. Understanding this distinction helps us separate short-term market reactions from signs that a deeper shift is underway in how money operates and is valued. To avoid being swept up by news headlines and short-term volatility, the most important thing is to understand the core operating mechanisms that are currently shaping the monetary system and capital flows. When these mechanisms are understood, viewers no longer react emotionally or become guided by sensational headlines, but are instead able to assess for themselves the level of risk and the true significance of each movement in the market. The first mechanism that needs to be clarified is that high debt, in and of itself, is not what destroys an economy. The cost of that debt is the decisive factor. A country can carry a very large debt burden for a long as interest payments remain within manageable limits. This is similar to a household or a business. Borrowing more or less is not as important as how much must be repaid each month relative to income. When interest rates are low, the burden of debt service is obscured because annual cash outflows are not very large. But when interest rates rise, the same amount of debt places an entirely different level of pressure on the budget. In the case of the United States today, interest payments have become a large and rapidly growing expenditure, directly competing with spending on defense, healthcare, and social welfare. The indicators to watch are not just total debt, but the ratio of interest costs to total government revenue, the growth rate of interest payments relative to economic growth, and the government's ability to refinance its obligations. When debt costs rise faster than revenue, policy flexibility narrows, forcing policymakers to choose between spending cuts, tax increases, or accepting higher inflation risks. The second mechanism is that institutional capital flows always move ahead of news and ahead of the emotions of the broader public. Large funds, banks, and institutional investors do not act based on media headlines, but on balance sheets, debt maturity structures, and medium to long-term policy risks. When these actors change their positioning, the market's temperament changes as well, even when everything appears normal on the surface. This shift typically occurs quietly, through adjustments in allocation, portfolio diversification, or a move toward more defensive assets. The signs of this process are not found in a single dramatic sell-off, but in a gradual decline in long-term demand, rising volatility, and increasing divergence between asset classes. The result is a market that becomes more sensitive to policy signals, where even small adjustments can be amplified because liquidity is no longer as abundant as before. The third mechanism relates to the central role of the US dollar in global chain reactions. The dollar is not only the currency of the United States, but also the primary currency for settlement, reserves, and borrowing for much of the world. When the dollar strengthens, economies and businesses that borrow in dollars face higher debt servicing costs, dollar-priced commodities come under downward pressure, and capital tends to flow back toward the United States. Conversely, when the dollar weakens, domestic inflationary pressure in the US increases, while other markets may benefit in the short term. What matters is that the dollar rarely moves in a simple, one-directional way. It reflects a dynamic balance between its role as a safe haven and internal pressures stemming from debt and monetary policy. Therefore, tracking the strength of the dollar helps reveal the degree of stress or easing in the global financial system, as well as how shocks can propagate from the United States to the rest of the world and back again. The fourth mechanism, and also the most fundamental one, is confidence. Money is, by its nature, a system built on collective trust. Confidence does not disappear in a single day, nor does it collapse simply because of one negative number. However, when confidence begins to waver, it becomes very clearly visible through higher yield demands from lenders. When investors require a larger risk premium to hold bonds, that is a signal that they are reassessing long-term risk. Signs of a shift in confidence can be seen in weak bond auctions, in the widening yield spreads between safe assets and risky assets, and in rising costs of credit risk insurance. The consequence of this process is mounting pressure across the entire financial system, because confidence is the glue that binds all financial contracts together. When these four mechanisms are viewed side by side, it becomes clear that the current picture is not a simple story of collapse or absolute safety. High debt becomes dangerous when its cost moves beyond control. Institutional capital flows send signals earlier than the news, but they do not always point to disaster. The US dollar plays a central role, amplifying both risk and stability. And confidence, while resilient, can still be tested when underlying conditions deteriorate over an extended period. Understanding these mechanisms helps viewers build a solid framework for reading the market, so they are not swept up by extreme scenarios, but instead focus on tracking signals, assessing conditions, and making disciplined decisions in an increasingly complex environment. When it comes to macroeconomic analysis, what matters is not retelling long stories from the past, but transforming data into a simple dashboard that shows observers what to look at and why it matters. Rather than trying to predict the future, we need a set of signals to monitor the present and to recognize early changes in the state of the system. The first signal to track is the yield on U.S. government bonds, particularly at medium and long maturities. When yields rise, it means lenders are demanding a higher risk premium to hold government debt. For the public, this is not merely a financial market issue, but one that directly affects mortgage rates, consumer loan rates, and corporate financing costs. A sustained rise in yields over time indicates structural pressure on the cost of capital, while short-term fluctuations usually reflect temporary sentiment. The second signal is the health of bond auctions. When the government issues new debt, investor interest and subscription ratios provide a very practical measure of confidence. If auctions proceed smoothly with strong demand, the system continues to function normally. But if demand is weak, the government is forced to accept higher yields, thereby increasing future debt costs. For the public, this is an indirect signal that budgetary pressure may spill over into taxes, public spending, or monetary policy. The third signal is the movement of the US dollar. Whether the dollar is strong or weak should not be judged emotionally, but in context. When global uncertainty rises, the dollar often strengthens due to its safe haven role. Conversely, when domestic pressures within the United States intensify, the dollar may weaken. Sharp fluctuations in the dollar reflect the system's state of tension. For consumers, a strong dollar can help ease pressure on import prices, while a weaker dollar increases inflation risks. The fourth signal is the price of gold. Gold does not generate cash flow and is not always a high-return investment, but it is a very effective indicator of market sentiment. When gold rises in an environment where real interest rates are not falling sharply, it suggests that investors are seeking protection against monetary and policy risks. For the public, this is a signal of heightened market unease, not a declaration that the system is about to collapse. The fifth signal is the credit spread between safe assets and risky assets. When this spread widens, investors demand a higher risk premium to lend to businesses. This typically signals a tightening of financial conditions, directly affecting employment, investment, and economic growth. When the spread narrows, the system tends to be more stable and more willing to accept risk. When these signals are viewed together, there is no need for a dramatic narrative. The state of the system can be read in real time. What matters is not looking at each signal in isolation, but observing whether they are aligned or in conflict with one another. When multiple signals point in the same direction, systemic risk increases. When signals diverge, the market is usually undergoing an adjustment rather than a crisis. History shows that this approach is far more effective than trying to predict market tops or bottoms. During the period when the United Kingdom faced fiscal difficulties in the 1970s, rising debt costs and weakening demand for bonds appeared before the country ultimately sought international assistance. At that time, the entire system did not collapse immediately. Instead, pressure accumulated gradually through higher capital costs and deteriorating market confidence. Similarly, in the early 1980s in the United States, sharply rising yields driven by anti-inflation policies caused a short-term recession, but also laid the foundation for subsequent stability. Japan presents a different scenario, in which persistently high debt did not lead to an immediate crisis, but instead produced decades of low growth as adjustment costs were spread out over time. These precedents demonstrate that there is no single inevitable outcome for economies facing pressure from debt and capital costs. What matters is identifying signals early, understanding the mechanisms behind them, and monitoring how they interact with one another. When this is done, macroeconomic analysis is no longer an abstract story, but becomes a practical tool that helps individuals understand the environment they are living in and make more appropriate decisions amid ongoing volatility. When bringing these macroeconomic analyses back to everyday life in the United States, it is essential to see how debt and interest rates are permeating every budgetary decision and every policy choice. As interest costs rise rapidly, the federal budget becomes constrained in very tangible ways. Every additional dollar spent on interest is a dollar that cannot be used for infrastructure investment, education, or social support programs. This pressure does not emerge all at once in a single year, but accumulates gradually, steadily narrowing fiscal space. As that space contracts, every new spending decision becomes more politically and economically sensitive. In that context, the Federal Reserve is caught between difficult choices. If it maintains high interest rates to control inflation and preserve policy credibility, economic growth will come under pressure, the labor market may cool, and borrowing costs for both businesses and households will remain elevated. Conversely, if it eases too early to support growth and relieve budgetary pressure, the risk of inflation returning increases, while the confidence of lenders may weaken. There is no perfect choice, and it is precisely this tension that creates the prolonged state of uncertainty currently reflected in the markets. In everyday life, the impact of this environment is very evident. Prices of goods and services do not rise in a straight line, but instead become more sensitive to cost shocks and policy changes. Consumers may see some items cool down in price, while essential services continue to remain expensive. High mortgage rates and consumer loan rates cause many households to postpone major decisions, from buying a home to expanding a personal business. This does not mean a crisis, but rather reflects a period of adjustment in which access to credit is no longer as easy as it once was. The labor market is also experiencing increasing divergence. Industries that rely heavily on cheap borrowing tend to be more cautious in hiring, while sectors tied to essential demand or stable profit margins are better able to maintain employment. As a result, people's perceptions of the economy can differ widely, with some experiencing clear hardship while others are relatively unaffected. This very divergence often amplifies feelings of uncertainty, even though aggregate indicators do not yet point to a systemic collapse. Asset prices most clearly reflect the shift in the monetary environment. Equities no longer rise uniformly, but instead diverge based on cash flow generation and sensitivity to interest rates. Real estate is not collapsing, but liquidity has declined and price growth has slowed, especially in areas that previously benefited the most from low interest rates. These movements are often overinterpreted in the media, while in reality they are the result of the repricing of capital costs. What matters most is distinguishing between genuine signals and noise. Short-term news about an inflation figure or a policy statement can trigger sharp daily or weekly volatility, but it does not always reflect long-term trends. True signals usually emerge when multiple factors deteriorate together over an extended period, such as persistently rising interest costs, prolonged weakness in bond demand, and a broad tightening of credit conditions. By contrast, when only one factor fluctuates while others remain stable, the market is usually undergoing an adjustment rather than entering a crisis. A reasonable approach in this phase is not to wait for a definitive conclusion about collapse or absolute safety, but to think in terms of conditions. If interest costs continue to rise while growth slows, risks to the budget and the labor market will increase. If inflation is brought under control without sacrificing too much growth, systemic pressure may gradually ease. Framing scenarios in conditional terms helps individuals maintain flexibility, rather than being pulled into extreme narratives. When looking ahead, rather than searching for a definitive conclusion that everything will be fine or that everything will collapse, a more responsible approach is to lay out scenarios and understand the conditions under which each scenario could occur. The first scenario is a gradual easing of pressure over time. In this case, inflation continues to cool in a relatively sustainable manner, allowing interest rates to decline slowly and in a controlled way. Debt costs no longer rise rapidly, the budget gains more room to maneuver, and asset markets gradually stabilize at a lower but healthier growth pace. This is a scenario in which the system self-adjusts after a prolonged period of cheap money, without the need for a major shock, but it requires policy discipline and patience from both markets and the public. The second scenario is prolonged difficulty. Inflation does not surge, but it does not fully disappear either, forcing interest rates to remain higher than historical norms for an extended period. The cost of capital becomes a persistent burden on the budget, businesses, and households. In this environment, growth slows, market volatility increases, and a sense of unease lingers. This is not a crisis in the sense of collapse, but rather an exhausting phase in which distortions accumulated in the past are gradually corrected through economic and social costs. The third scenario is a confidence shock, which would occur only if there were a sufficiently large triggering event. This could be a policy shock, a geopolitical event, or a financial incident that causes lender confidence to deteriorate abruptly. In this case, market reactions would be strong and rapid, interest rates would swing sharply, liquidity would contract, and defensive sentiment would spread widely. However, even this scenario is not predetermined, it depends on how policymakers and markets respond after the initial shock. Regardless of which scenario unfolds, principle-based actions retain their value. Reducing concentrated risk helps avoid having everything depend on a single assumption. Managing personal and corporate debt becomes more important in an environment of high capital costs. Systematically monitoring macroeconomic signals helps distinguish between short-term volatility and structural change. Equally important is investing in income-generating capacity and adaptability, as these are the assets least affected by monetary cycles. Understanding the cycle is not about fear, but about disciplined action. When people know where they stand in the cycle and which conditions could increase risk, they are less likely to be swept up by news and emotion. If you find these analyses useful, leave a comment to share your perspective and follow the next part, where we will continue to unpack how asset classes and personal financial decisions can adapt in a changing monetary environment.